Our first company is Prime Financial Group, trading under the ASX code PFG with a market capitalisation of around $54 million. It's an advisory, capital and asset management group operating across 4 key areas in accounting, business advisory, wealth management, SMSF and capital in its 3 core locations of Melbourne, Sydney and Brisbane. Presenting for the company today, we have CEO, Managing Director and Chairman, Mr. Simon Matter. Simon, please take it away.
Right, thanks, Peter, and thanks for the opportunity. Welcome, everyone. I'm going to give you a quick update on our results, but start with a bit of background on the business. So if we can go to the first slide, please. So as Peter rightly identified, we are an advice, capital and asset management business, but we really do focus in on assisting emerging businesses, founders and high net worth investors. And the 4 key services that Peter spoke about are not terribly unique in their own right, but what is unique is the way that we connect them together to deliver a completely connected and integrated solution for really those emerging businesses, founders and high net worth investors. So we want to be that destination where they go and they don't need to go and seek any other external advice. The business has been around for 26 years. We have almost 200 team members. We have a global footprint and currently manage about $1.2 billion within our wealth management division. Next slide, please. So in terms of what we do, when we think about those client segments that I spoke about, we really break it down into really 2 key areas. Our business segment, which is our accounting and business advisory, and also our capital and corporate finance or corporate advisory. And those 2 key components make up about 54% of our overall revenue. And they're an important part of how we're able to deliver a complete service for our clients. In terms of the wealth segment, we have wealth management, which is really everything from financial planning to investment advice to superannuation, life insurance, etc. But we really do focus in there on high net worth investors and wholesale investors. And we really differentiate in terms of what we do within the alternative investment and also the property space as well. Between the wealth management part of what we do and also the SMSF part, which is about advising SMSFs and establishing them and administering them, that part of our business in the wealth segment has around about 46% of our overall revenue. Importantly, we are one brand that is delivering these connected set of services for these key customers. But we have a centralised services team that covers everything from finance to IT, HR, marketing and operations. And there's 30 team members that work to assist the development and the delivery of our overall services. Next slide, please. This is how we like to show diagrammatically how we actually operate in these 2 key segments. So for us, in terms of how we go about doing this, we're scaling our business in 2 key ways. One, organically, so we're able to grow our business organically about 15 to 20% each year, and also through acquisitions. And those acquisitions are offering us an increased customer base to offer services to, and often increased capability as well. So when you look at the left-hand side there, it is all about this complete solution for business and also on the right-hand side for wealth. And what you can see there is we put our clients right in the centre of everything that we're doing, and we make sure that we surround them with all of what they're going to need to be able to execute on their aspirations. And the same thing from a wealth segment point of view. We make sure that we are able to look after everything that they need within this one comprehensive offering. Next slide, please. So those are the important key things that we've just reported on a couple of days ago. So most importantly, we delivered on our guidance. Our revenue is up 21% to $40.8 million. We guided the market to 15 to 20%, so that was at the higher end of that range. We guided to 10 to 15% EBITDA growth for the year, and we had 18% at $10.2 million. Our EBITDA margin was at 25%, which was pretty consistent with the previous year. Our EPS was 1.37 cents per share because we made a significant investment in new services in the first half, but our second half was very strong and very much representative of what we're thinking for FY25. Our dividends increased by 7%. Our final dividend will be 0.85 cents per share, and we guided to 5 to 10%, so right in the middle of that range there. In terms of our debt to underlying EBITDA, it's about 1.1 times, but we did actually raise some capital towards the tail end of the financial year, which actually landed in our account in the first couple of days of FY25, which would have made it about 0.9 times underlying EBITDA. So a really strong set of financials with a good growth trajectory for the business and very positive about what we're achieving as a combined team. Next slide, please. Just in terms of touching on the real operational highlights for the year, when you look at those two segments of our business, the wealth component and also the business part, one was up 24%, the other one was up 19%. And the thing that I guess we're most proud of in terms of this year is not just the organic growth that we've driven within the business, but the fact that we've been expanding by acquisition as well. And what you see there on the right-hand side is two of the key businesses that we acquired in the second half of the year. One was a funds management business that focused in the alternative asset space, and already that business has connected in with the whole of our team and is working with our corporate finance team and our property teams to work on joint transactions and to develop new products, including a social infrastructure fund within our property space. The second acquisition we did, which was only in June, was an employee share plan administration remuneration business, EPM, and that is very much about employee ownership within business and making sure that those businesses are getting great advice as to how to incentivise teams to get great performance. And so that fits in very nicely with helping businesses think about the sort of teams that you need to have and the sort of structures and those incentives that can be available to grow those businesses for the team. So that fits in very nicely, one in the wealth segment being LTOR and the funds management part, and the other part being within that business segment as mentioned. The second half performance was very strong, and what I would highlight is that we are going to continue to focus on EPS accredited transactions that will be able to add to our capability and our client base. Next slide, please. In terms of our revenue growth, it's really accelerated in the last 3 years, and what we're lucky to see within our business is a really high level of recurring revenue from existing customers. So over 70% of our revenue each year is generated from the existing customer base, and we're targeting to see that increase to 75 and 80% over coming years. And some of those acquisitions we just did in the second half actually have a higher portion of their revenue being recurring. So not just an attractive client base that we can do more for, but an attractive revenue profile as well. And what you're seeing there at the bottom of the screen is really all of our divisions, bar the SMSF division, really growing at quite a rapid rate. Our wealth division had a fantastic year, up 40% on the previous year. Our accounting division, which is PABA, Prime Accounting and Business Advisory, up 8%, and our capital and consulting division up 39%. SMSF was a bit softer. We didn't win as much work as we expected to, but that will go back into a pro-growth mode in FY25. Importantly, we did 41 million of revenue, as I said, for the year, and we are targeting to get to 50 million of revenue by FY25. Next slide, please. Here's an outline of the strong financial performance for the business over the last 5-year period of time. And these are really the key things that we look at. Underlying EBITDA, compound annual growth of 16%, reported profit up, earnings per share had moderated because of the first half of this year, and dividends up 37% on a compounding basis. So a really strong track record of performance. Next slide, please. So the great thing about what we do within that business and that wealth segment is that we're operating in attractive markets that have really strong tailwinds. And with this focus on emerging businesses, founders and high net worth and how we bring this together into a very complete service, we're really privileged to be able to see that the segments that we play in growing. So the second bullet point there is really important. There's 635,000 people in this country that have between $2.5 and $5 million from a wealth point of view, and that grew by 45,000 people in the last 12 months. So that's really encouraging, and there's going to be a significant amount of wealth that is transferred between generations over the next 5 to 10 years, and often those people receiving that capital or those funds, whether it's a business, whether it's a share portfolio or property, they're going to need advice. And in this country, there's probably half as many advisors as there were 5 years ago. So a great opportunity for us to own that space for that high net worth individual and family group. And there's often a very strong connection between that and business owners, which is another core part of where we focus our business. So if you look at the right-hand table there and you look at the established affluent, you'll see the last two columns and the ultra high net worth. There's a real consistency between them having, call it $5 to $70 million of wealth, but they've all often got self-managed super funds and they're also often business owners. So the opportunity to connect this ecosystem with a complete advice solution is where we're focusing our attention. Next slide, please. This is the simplicity of our business. These are the pillars. Prime place to be. So we want our staff to have a fantastic experience and our clients as well, obviously. We want to be able to compel our clients to do more with us because we've got great services and no need to go anywhere else. We want to have a simple business structure that drives efficiencies and outcomes, and we want to grow both organically and also inorganically as well. Next slide, please. So this is just a bit of a recap in terms of how we think about the business. We grow organically by the existing services that we've got growing, cross-selling more services to our existing customers, starting new services, and also identifying emerging areas where we can be of additional value to our customers. So that's a continuation of the last 5 years. And more recently, in the last 20 months, we've undertaken 3 acquisitions that increase the scale and the capability of our group. And we are absolutely on track. And we said back in FY22 with $26 million of revenue that we wanted to double revenue in 3 years to FY25 to $50 million. Absolutely on track in terms of that. And then we wanted to double revenue again within the next 3 to 5 years to $100 million. So we have strong growth aspirations, but importantly, we have the capability to execute on that and the track record. Next slide, please. So really, this is the final point that I'd make today. We are expecting to grow revenue by 15 to 20% again into FY25. That will be the organic growth, the accretive acquisitions that we make and that we integrate, scaling efficiently, and that should lead to not just growth in revenue, but also earnings and dividends as well. So the business is in great shape, and I think the investment case for our business makes a whole heap of sense whether you're looking for a dividend or a growth stock as well. We fit nicely into both buckets. That's the end of my presentation today, Peter. Hopefully I've hit the high marks and the things that you need to hear from me today.
Simon, thank you. We do have some questions for you.
Right.
So just firstly, the business is obviously broken up into 2 segments. You've got the business segment and you've got the wealth segment. But which one of these segments contributes most to the revenue, and which segment will provide the most growth in future?
Yeah, so there's about 54% of the businesses coming from the business segment. So looking after those SMEs and probably more medium-sized businesses that are turning over $5-10 million plus. That part of our business has continued to grow quite strongly, and that's made up of both our accounting division and also our corporate finance division. And each one of them grew 8% and 39% respectively for the year. So that's really been accelerating well. If you look at the wealth segment, that grew by 24% versus the previous year. The wealth management piece grew by 40%, and SMSF marginally came back for the year. So I think the nice part about our business, Peter, is the fact that it's actually quite equally weighted between the two. And I have expectations that each part of our business will be growing by 15 to 20% each year. But where I think we really get a great complementary outcome is the way those 2 segments interact with each other and really feed each other in terms of opportunities and clients that we can share to deliver ideally great outcomes. So my view is the whole business should be growing as we sort of move forward into 25 and beyond.
Well, just on that, obviously your fiscal year 24 results were strong. Revenue was up 20%, EBITDA was up 18%. Can you explain the reasoning behind this?
Yeah, so I think the fact that we've had a pretty strong cost control within our business, and when you're obviously growing revenue and quite a decent amount of that is dropping to the bottom line, that's been important, but also making sure that you're turning that into operating cash flow as well. So we've had the benefit of improving our operating cash flow for the year by 36% as well. So I think really the key thing for us is make sure you're growing the top line, looking after your costs, making sure that you're acquiring businesses that are EPS accretive and that you can leverage off your existing cost base. That's really been our strategy for the last 3, 4, 5 years. So yeah, I think it's important to be part of a growing business, but making sure that you've got the right amount dropping to the bottom line. And our EBITDA margins are typically between 25 and 30%. So it's a good cash generative business and pretty profitable in terms of margin.
For sure, Simon. And just one question to wrap up. How significant is the acquisition of the EPM business?
So EPM's a great business. It turns over about $2.3 million, 2.3 million. It's also highly profitable. So it's actually above our standard EBITDA margin. But what we really like about the EPM business, which is in the employee share plan management and remuneration consulting space, is this deep belief that I think if you've got high employee ownership within business, you can actually get better overall outcomes for everyone. And we as a business have had the benefit of that structure. This year we'll have 80 of our 196 team members will be shareholders in our company, and more joining every year. So when you get that working really well, we think that could be a business succession solution for transition of some wealth out there and business wealth. So yeah, it's important in terms of the business offering that we've got, but it's also important, I think, in terms of the future as well. So yeah, we really like that space.
Simon, thank you so much for your time today. Have a great weekend.
Thank you. I appreciate the opportunity, Peter. Have a good one.